I'm Kyle Floyd. I'm the CEO of VOX Royalty Corp. We are a purchaser of third-party royalties. We aggregate those third-party royalties into a portfolio for our shareholders. We focus on precious metals. We focus on assets that are typically anywhere from a day to 3 years out from production. And we are focused on disciplined capital allocation in the royalty sector. We believe that royalties are the best way to generate commodity exposure, and we built a business aroround that strategy.
Hey, Carl, thanks for joining us. I haven't seen you for a while, so I thought I'd better reach out and see how you are, because you've been quite busy since we last spoke. But I'm going to let you in a secret. I'm here to talk about the market, because the royalty market has gone a little bit wonky, and I want to get your take on maybe what's been happening out there. But let's talk about you first of all. So what have you done since we last spoke? It's
been a really productive quarter for us in terms of what's absolutely been generated at a foundational level in our portfolio. Not a tremendous amount of deals announced, but a tremendous amount of growth has been announced through our operating partners that operate our portfolio of assets. And so it's that organic growth that we've been referencing now for a very long time that I think separates us from a lot of the pack in the royalty sector that has surfaced, and I think has provided a lot of clarity for our investors and for our shareholders in terms of the value that's being created without us doing any additional transactions.
Okay, so last time when we've spoken on a couple of other cases, we talked about the discipline required. Okay, so some people in certain markets lose their minds and they spend money they haven't, they spend money they shouldn't, and they pay more than they definitely pay more than they should. And I'm just wondering. Look, I can't. I guess you can't talk about specific companies. Wouldn't expect you to. But for me, when I'm looking across the industry, it makes me nervous. Okay, the precious metal market has come off, sure, for the last 12 months, but we've seen huge declines in the equities of some of the royalty companies. Yours seems to be the only one that's gone up. What have you done right that the others have got wrong?
Yeah, for VOX, it's been about discipline. And I think one of the benefits of our business model and of our management team is we've been there through cycles. And last year, it was really easy for companies to buy very, very expensive assets at valuations that didn't make any sense. And I think the market has digested that, it understands it, and it wants to see in whatever it's buying, generate value, generate return on assets, and generate the types of returns that you need to generate in this sector to reward investors. And I think a lot of the companies in our sector got ahead of themselves, believed that gold was going to much higher prices. It's obviously retrenched a little bit, and that's left them exposed to what the market is today. Whereas we've been very disciplined. We said, hey, we haven't won a process on a deal. A lot of the processes that got shot, look, we see them, but we pass on them because ultimately the price that was paid for these assets was just far too much in our opinion. But meanwhile, we've closed on a number of different transactions that have surfaced value. It's demonstrated that our discipline works. And it's demonstrated that it's going to generate the types of returns that investors should expect.
Why do you think us retail and family office investors get sucked into that rhetoric? Okay, there's a few kind of carnival barkers last year talking about $3,000 gold, $5,000 gold, $10,000. Everything looks good when there's $10,000 gold, right? It's hard not to make money at those levels, but that's not the reality of it. But huge swathes of people got attracted to that rhetoric. And we saw some huge meteoric rises for some royalty companies in the precious metal space. And those people have been left hanging. How do those companies get out of that situation? How do they retrench into get into better deals? Can they recover? What do they need to do to recover?
A really hard question, and I'll tell you why. Most of the royalty sector, these companies don't have competitive advantages in terms of finding good royalties at good value. They're beholden to banks to bring processes of shopped royalties, and then in turn buy those royalties at what ultimately ends up happening is the highest strategic value to the group ends up buying that royalty. But strategic value can mean different things to different people, and ultimately means that the prices paid for these assets are exceedingly high, and probably we've all heard of the winner's curse. It's a challenge. It's a challenge. It's a challenge if you don't have a competitive advantage in terms of sourcing deals and building your business. at good value, you're going to have a problem for a very, very long time. So I don't know how those companies get out of that situation because they haven't built the competitive advantages. They came into the royalty space because it seemed sexy, it seemed hot. And in some respects it was, but over the long term, the good business models typically pan out.
Well, that concerns me. That concerns me because that means a lot of retail have been brought into a scenario which is deemed to failure in a market like now, right? So I think last year was a fairly frothy market, a lot of sentiment being driven and gold going to the moon because of the economy, etc. Those guys left high and dry. I mean, I literally wouldn't know what to say to people like that in terms of what they should do with the investments that they've got. I suspect most of them will sit and hold on as long as possible in the hope that the market turns. Do you think there's a chance that the market will turn for precious metals? I mean, what's gold going to do next year? You got a thought on that?
I don't like to speculate on gold price. I'll tell you how we price our deals. We price gold going down. I personally might feel that gold goes up over the long term, but that does not influence how we invest. We invest on the basis that gold is likely to decline in value, along with the entire suite of commodities, hard rock mining commodities that will entertain royalties on or purchasing royalties. So the reality is we use a consensus price deck that typically has most metal prices, if not all of them, decreasing significantly below spot prices. So that's our business model. We don't get lost in the gold going higher conversation. And I'll tell you, that helps serve our investors well.
So let's look at some of the ratios. I think we've talked about a couple of the ratios that are important in the past, because this game is about a return on the asset, right? You've got to think in those terms. So what should we, naive investors be looking for? So if we listen to royalty company CEOs in the future, what's the part of their pitch that is most important for us to understand?
Well, you have to understand the royalty model makes money. It should make money in two respects. It should make money. This is our belief, both in terms of what you're buying now and what is in the ground. You should make money on that. And then there's the option value about what you don't know. You can speculate on what you don't know. And a lot of royalty companies out there are paying absolutely full value for everything that is in the ground now, or believe is in the ground now, and believe is mineable. And then you're also paying a premium on top of that, so a premium to net asset value, and hoping that there's discoveries and increases. So increase the resources and reserves through new discoveries, and hoping that there's increases in metal prices. Well, if those two things don't happen, and you've paid more for that asset than what is there right now, you've already lost money for your investors. And that is something that we don't do. That is something that a lot of the companies in the royalty sector are doing. So I would say, I believe the better model is make money on what you're buying with what and then also get the option value. But that comes along, you're not paying for that when you don't know what that could be. But the reality is most royalty companies are going about it that way, which means their ultimate return on assets can be negative or very, very low.
So if we talk to investors and they say, well, what should I do with my portfolio? We talk about having sort of steady state revenue, whether it be dividend paying or just cash flowing businesses, which go up at a modest pace, but it's going to keep going because there's a fundamentally good business. And we say, and if you've got some spare cash, maybe you can invest in some higher leverage place, which might get you a bigger return. It might not, but it won't matter in the context of your portfolio. Could you guys not employ the same strategy? Would you not just say occasionally, discipline is great and all that, but maybe we can knock it out of the park with one or two of these dollars of ours?
We take a portfolio approach to what we buy. We have amazing exposure that we've generated for our investors. We have 35 million gold equivalent ounces covered under royalty within our projects that we have royalties over. We have 5 production stage assets going to 10 production stage assets going to much more than that. So we absolutely derive that leverage and that optionality upside. I think you can generate both for investors. And, I'll give you an example. We had a royalty that we were exclusive on under LOI. It was in the $100 million price tag range. And it was a world-class ore body. It was a generational royalty. a lot of people in our industry said, well, why didn't you do it? The reality was its ultimate return on assets and return on invested capital for us was going to really diminish what our existing portfolio is generating and is going to continue to be capable of generating. So while we had it at great value and someone ultimately transacted on it at a much higher price, it was really going to deteriorate our return on assets and our return on invested capital, which are metrics that we're watching very closely for our shareholders. And we think will ultimately, produce the highest return and highest share price and share price growth for our business and for our shareholders. So that's our model. But, most of the royalty companies, I'll tell you, if they would have had that royalty under exclusive option, would have absolutely executed on it. The returns would have been 2-3%, could have obviously gone up. But that's tough when you're investing in the small end of the royalty sector. You should be expecting better returns than that. And that overall would have been, lowering certainly the average return that we're generating on our assets and on our business.
So we've been analysing some of the acquisitions made by royalty companies over the past 12 months, and we've spoken to a lot of royalty companies. And, in a few instances, we've seen royalty companies justify the price that they pay based on today's price of gold, right? So in some cases that was, $1,950 gold, right? Which today looks a bit foolish. But is there anything wrong with doing that at the time? Should companies be discounting? Should royalty companies be discounting the price? You talk about looking at a lower price for your deals. But is there anything wrong with looking at spot as an acquisition price?
There's everything wrong with it. And if you look at the mining companies, and I believe there's data that supports this, the mining companies that have outperformed have been very, very disciplined on capital allocation. They use a much lower gold price when they're modeling out assets and modeling out how they're going to deploy their capital. The companies that have, let's say, been exuberant in times when metal prices are running, I think have been proven to be the worst performers in the industry. So we've been disciplined. We've been very targeted in terms of what we acquire, and we don't use spot. And that's part of our business model, which is we're going to return investors. We expect to generate return for our investors at lower prices than where metal's trading today. And I think that is what supports the risk-adjusted benefits of owning a royalty company. A royalty company is out there buying assets at premium to net asset value. You're taking on a lot of risk for some leveraged upside, sure. But there's better ways to get that leverage upside then.
Okay, and another kind of question from me, because it was something I didn't really understand last year. There were portfolios and deals being done on multiples which just seemed way out of whack with, how soon cash would come through. Little things like that. So a company would come in and buy a portfolio of assets, which not all of which were good. Some may have been good, some were mediocre, and some were questionable, but they all got the same multiple. Is that the saving grace here for some of the companies which perhaps are struggling a bit in an environment like now? M&A will come along and solve their problem because they will get a straight multiple across all of their portfolio, in which case they could give their shareholders a decent return. Or are they sitting there waiting for the price of gold or whatever commodity to go up? I mean, they seem like the two options available to them.
I think they really only have one option available to them, and that's going to be wait it out and hope that a much higher commodity price comes their way. The reality is the majors have been pretty disciplined in terms of what royalty companies they'll acquire. There obviously is a relatively new entrant in the space that's been a little bit more aggressive in terms of M&A. But there are truly only probably certain companies sub $500 million in the royalty space that a third party could come to value on and actually purchase. There's not very many, in my opinion. So I don't believe that M&A is going to bail out a lot of the bad investment decisions that have been made over the last few years in the sector. And so the only option then for that business and for their shareholders is to hope that metal prices increase and ultimately, they can exit. But that's my opinion on the space.
Okay, so you're saying that the market or retail has been fooled by marketing, promotion, but industry players are unlikely to walk in and solve their problems. by picking up projects, assets which are subpar. Okay, that's not good.
It's not good if you've been investing in royalty companies that have been very aggressive using, let's say, spot prices to value deals and needing every bit of resource to reserve conversion to happen. Those are some of the issues in the industry right now. So it will very likely be a very tough ride for some of those companies if they're not bailed out with just a much, much higher commodity price cycle, which I don't think anyone can expect. I think you have to plan for the worst and make money really in a worst case type scenario.
Okay, so a bunch of resetting of expectations across the board. And I think we probably go back and look at our data and try and understand where some of those companies sit today. For you, looking forward, have you any reason to believe that your revenue projections are not on track?
No, look, our revenue projections, we came out with guidance. We doubled our revenue guidance just a few months back. Everything continues to track. We obviously, one of the big wins for us was iron ore was at all-time high prices. That's backed off a little bit. But again, I think, we're tracking the guidance very, very well. And then next year, we have an abundance of assets coming online. Segalola, that's operated by Thor Exploration, has just announced first gold pour on commercial production. That comes online. Boolong is a Western Australian gold asset that is projected to come online mid next year. And then we have a number of other projects also expected to come online next year. So, we've got every reason to believe that we're going to continue generating really, really nice revenue growth. And also, continuing to deploy our capital very efficiently.
Okay, so royalties is and can be a good commodity class, a good class, investment class to get into, but you need to look at the detail.
You have to look at the detail, yeah. And I think the investors need to be asking the CEOs and the investment decision makers and understanding who those are in these companies. What is their track record? What is their experience? Are they mining engineers? Are they geologists? Have they invested capital previously in this space? Do they have a track record of success? They need to ask the hard questions because there's a lot of companies out there that are trying to do deals for the sake of marketing value or increasing their notoriety, whatever the case may be, but it's not coming down to fundamentals. And I think that's a real issue in the industry right now. And so investors have to start asking some of the harder questions, I think, to understand, are they investing? The royalty industry has become its own cottage industry. And so sophistication in the sector has to grow. And for those that put the time in to learn a little bit more, and obviously we're here to try and help in that process, they're going to be able to discern, I think, what a good royalty company looks like from maybe the rest.
But it's a difficult thing, Kat, because last year everyone was excited, not just retail, not just family offices, but the brokers, the bankers. It was an environment where you could raise money for anything. And I've had a couple of CEOs recently, this month, say to me, there's too many junior exploration companies for gold out there. With royalty companies and streaming companies going through what they're going through at the moment, i.e. the hard lessons of where you should and shouldn't place your money, there's going to be a little bit less optionality for junior gold exploration companies, certainly the rest of this year and next, unless it stands up to scrutiny. And hopefully brokers and bankers pay a little bit more attention to that and instead of their fees, would be my feeling on the subject.
The junior space is very, very difficult. The majors have basically said they're not going to go do all the exploration work for the industry. And so that really does push it down to the junior end of the sector. And there are obviously those really big wins that can be generated, but it's a tough industry to invest in. There's a lot of people that don't know what they're doing, and there's a few people that do know what they're doing. And you have to tip your cap to those that do know what they're doing and are doing the hard work to find the deposits and prove those deposits out. And so, it's tough because it's very difficult to weed out those that know what they're doing from those that don't. And then it makes the job harder on those that do and that are able to generate returns for their shareholders. They have to compete with a lot of noise out there. So, it's one of the things I think the sector can improve. But look, it's tough being a junior company out there. I respect them for what they're doing. It's the hard yard industry for sure. But it is tough for investors to be able to discern, the good opportunities from bad opportunities for sure.
That's kind of interesting, actually, Kyle.
I founded VOX, we created VOX to be that outlet for retail investors and foreign investors looking for commodity exposure. So they didn't have to be mining engineers and geologists to try and pick these assets and spend the time that's needed to really understand the junior end of the sector. And so that's why this business was created. That's why, I think we present as a really interesting investment idea and platform for investors that want the commodity exposure. They want a little bit less risk. They want that leveraged upside. That's why this business was created. And I think we offer that well for our shareholders and our investors.